If you run a profitable business but can't qualify for a mortgage, it's not your fault. It's the system that's broken. Lenders weren't built for entrepreneurs. Their rules were designed around predictable W-2 jobs, not dynamic businesses. So you have to know how to play by their rules without compromising your financial reality. If you don't understand the game, you'll keep getting punished for being smart with your money. Delayed approvals, low loan amounts, or flat out denials, even when your business is thriving. I'm Andrew Russell, owner and founder of RCG Mortgage, and I work with thousands and thousands of business owners, entrepreneurs, ensuring that I set them up for success from a mortgage perspective. So as you can see, I have the most amazing bald head shave that you've ever seen in the mortgage influencer space, like ever. So it turns out, guilty pleasure, I go in once a week for a hot shave. Now I sat down in my amazing place, shout out to my barber, and getting my hot shave. And as what always happens, he applied for a mortgage, didn't reach out to his boy like a fool. Again, all his money was parked at, a big bank, and he got denied. He's self-employed. From a business perspective, he's self-employed, owns his own business, a very successful barber shop that has tons of clients. They do very well. But this lender asked him for his 2 years tax returns, which may or may not have been correct. Looked at them, and the most recent year, there was a huge loss called a carryover loss. So it's a huge loss from when he first opened the barbershop 3-4 years ago, and it kind of carried over and, brought down his taxable income, which is cool, right? You want your taxable income to be brought down, especially when you're buying a house, right? Wrong. But that was a big problem, number one. Number two, they just went off of one line on his tax return, didn't look at some of the other lines. They were just and I've never heard of a calculation done this way. It was super, keep it simple, I guess, but it turned out to actually hurt this client. So that affected him, number two, which we'll talk about in a little bit. And number three, there's a loan year over year that there's a loan that actually has to get paid back within 12 months. So when his tax returns, they saw that. So after it's all said and done, he, to the lender at least, he showed a loss in terms of income. Like he wasn't going to try again. It was pretty crazy. And I was like, broski, you remember what I do for a living, right? So I was like, just do me a favor. It's free. First, let me take a forensic look at your 2-year tax returns. Let me see what they saw and see if we can make it any better. So I took a look, and it turns out this big bank, they had these weird overlays for self-employed clients. Now, what's an overlay? An overlay is if the government allows it, but the bank puts a more conservative, more restrictive guideline on top of it. Now, specifically, it was 3 things for my barber. Number one, turns out that when he first opened his barbershop, there was a lot of expenses. And if you think about a barbershop, you need the customers, it takes time, so you got to build. So there was a huge loss that he had his first year. So he actually, you can only write off, believe it or not, in IRS land, a certain amount where if you keep writing off the full loss for the year, there's no benefits. You can take pieces of that loss and push it to future years to write down the future year's taxable income. Now that's actually a paper loss. So even though it happened 3-4 years ago, whatever it was, he was able to take a huge chunk of that loss, called $100,000, write down his taxable income, pay less to the IRS, but it wasn't an actual loss. It was a paper loss from years ago. It didn't just happen. So with a CPA letter, we're able to actually discount that loss and remove it and get that $100,000 back. That was the first thing. Second thing is they just went off of the bottom line profit. They didn't see that he had depreciation. Now, depreciation, he has various things that depreciate. The value of the asset in a store, the chairs, right? Barber chairs, it's a thing. Some of the equipment, all that stuff could get kind of pricey. And there's a number the accountant can file for depreciation. And although it lowers your taxable income because it's an expense, it's not a real expense. So it's more of like a subjective paper expense. So you get to add that back as well. So we went and saw that depreciation line, which is pretty high because of the equipment, added it back to his net income. That was the second piece. Got that $100,000 back, and another $50,000-$60,000 back from that depreciation side. And the third thing was he had a loan due every 12 months, but every year they kept rolling it into a new one. We're able to get another CPA letter that says that loan keeps turning over every year, and it's not actually due within 12 months, although it appears that it is. Between those 3 things, we got back over $200,000 in net profit for the year, and that easy he was able to to qualify. But it just goes to show, sometimes if you go to the wrong place and you're self-employed, whether you don't show a certain amount of profit, but there's an expense like depreciation, we can add back an income, which we'll go over. What does that even mean? We'll show you. Or if there's a rollover loan year over year, where typically vanilla lenders may hit you for that, we actually were able to give it back to him. That's a piece of it. Or there's a carryover loss of a previous year. It's great for IRS perspective, but for mortgage, if you don't work with the right company, they don't add that back, and it shows even more of a drain to your net profit. It's super important who you work with, because this type of stuff requires someone to really be a specialist in this type of mortgage. But with a quick forensic, only took me a matter of minutes. I told him exactly what we need to put him on a path to success, and that's exactly what we did for him. He was able to find a house after getting pre-approved, and him and his family were able to move in only a handful of months after he thought he was actually going to get denied. But of course, hey, Andrew, self-employed income is so difficult. How do we make sure we work with someone that specializes in it? Now, typically, broker companies have access to a wider array of lenders, underwriters, and products. You always want to make sure if you're self-employed, you definitely want to work with a broker. Now, Andrew, I'm killing it year to date in my business. It's July, and you're killing it year to date, but last year on your taxes, you didn't show as much the year before. I know it's frustrating, and I wish it were different, but as it stands, not even good old Andrew Russell can change that. We don't go off if you're self-employed, you're year to date. You could be a cajillionaire year to date. You're going to have to wait until you file the following year. Now, there's always caveats to that. FHA allows an audited profit and loss, and then you can average it into the previous 2 years. But say you opened up your business 3 years ago, and finally you've cracked the code, and in the last several months, year to date, not off your last year's tax returns, you are killing it. You're going to have to wait till you file. There's no way around that. But that is something that's super important. Or, hey, Andrew, should I give myself a super high W-2 or pay stubs and just show a loss on the corporation side, right? Like the K1 or something of the sort. There's so much that goes into it. What makes sense, guys, is we're going to open up the exact playbook. If you're self-employed, getting a conventional or an FHA, the typical mortgage we go off tax returns, we're going to show you all the different form types, whether it's Schedule C, we'll look at an S Corp, we'll look at a 1065 or a partnership, what the lender underwriting team looks at, all the different rows, what the expenses mean. We're going to go over all of them together, so you as a self-employed client will feel empowered to know with your tax return, if you ever want to have a glass of wine on a Friday night, look at your returns, what would the lender give you credit for income? All right, you see this? This is everything you need to know if you're self-employed and trying to get a conventional or an FHA VA type mortgage. How do they calculate your income? Because you got these things called tax returns, right? And they're super confusing. So this is all the stuff, guys, you're going to need to know. We're going to go over it all together. I'm going to lay it out on the board and make it easy to understand, keep it simple, and show you exactly how the underwriting team at the lenders you work with should, and I say should because they don't all, but at least you're empowered. So if they don't, you know that they should, and you may not be working with the right place, how they calculate your income. But before we do, guys, make sure you go in the description, click the link, get yourself our free self-employed income cheat sheet. Super important. It's free. I made it just for you guys. Make sure you get it, because all this stuff we're about to go over, it gets a little confusing. Not for me. It's what I do for a living. I'm sure it wouldn't be the best in your industry, right? Self-employed client, entrepreneur. So make sure you get that free self-employed cheat sheet. Description, link, click it. It's free. All right, so let's break it all down, guys. So the first thing is, so we have the Fannie Mae cash flow analysis form. So what does this mean? Real simple. This form shows you how most lenders calculate your income by looking at these crazy things here called your tax returns, whether it's your Schedule C. We're gonna go off that, an 1120S, which is for a corporation, an S Corp, a partnership. Those are the examples that we're gonna use. All right, so if you look at this form, it's gonna show you all the different ways to kind of slice and dice self-employed income. So believe it or not, it's just as simple as taking the incomes and putting it right here. All right, so sometimes you have a W-2 from your self-employment jobs where you give yourself a W-2. Some people do, some people don't. So there's a section for that. Now, some of this stuff otherwise, it doesn't necessarily apply if you're self-employed. So Schedule C, which we're gonna go over, your net profit or loss. What the heck is a non-recurring other income loss or expense? Depletion, depreciation, travel and meal expenses, business use of home, amortization, casualty loss. What the heck is that, and why are there plus signs next to it? We're going to go over that together on a Schedule C. Now, we're also going to look at a partnership, right? So a partnership, right? could only be considered if you look at some things like a K1 and various other stuff. What the heck is a K1? We'll look at a K1. We'll look at all this stuff along with a 1065. So what's a 1065? Again, just like a Schedule C. It's just another tax form. What does it mean? You know, partnership income. Again, depreciation, depletion, amortization, casualty loss. As we alluded to before, mortgage notes payable in less than a year, meal and entertainment expenses. What does that all mean? Why are some, would you remove it from the income? Why do you add some of this stuff back? We'll look at that as well. And of course, an 1120S, we'll save the 1065 for last. The 1120S we'll look at second. Again, the K1, but also depreciation, depletion. Why is that a plus or adding it back? Amortization or casualty loss. Why are you potentially adding it back? Mortgage notes bond payable in less than a year, meals and entertainment, of course, multiplying by ownership. This is all the stuff that we'll look at. So, this is a really cool form. An 1120 is a C Corp, not as popular with mortgage clients, so we won't go over that. A lot of this is kind of self-explanatory because it's repetitive, but we're not going to go over that. So, they give you a great illustration in the back, a 1040, W-2 income from self-employment is wages paid to borrowers from the borrower's business. It can be confirmed by matching the EIN. So just remember, you have a social typically, right? You have a social, your business might have an EIN number, an employment identification number. It kind of looks like a social, but it's different. I think the first two numbers, then there's a dash. Typically a social is 3, then 2, then 4. And when a business returns are obtained, W-2 wages can be cross-referenced with a compensation of officers section. So typically a business as an expense could take that W-2 income that they're giving you, but it's still income for yourself. So how do you use it? How do you average it? How do you figure out what if your year-to-date is higher than last year's W-2? We'll kind of talk through all that. Schedule C, which is very popular for solopreneurs, your net profit or loss. What is profit versus revenue? I'll show you exactly where to look on your form, just so it makes complete sense. Reoccurring income, things of the sort, depletion, depreciation. Why the heck would you add it back? I'll show you exactly where it is and why. Meals and entertainment, business use of home. We'll kind of go over that together. Of course, we're not going to look at farming, folks. We'll save that for another video. If you hit me up and tell me you actually want me to do a video around that, let me know. But typically, we haven't hit farming in quite some time. 1065 partnership income, the K1, some of the income and losses here, as you can see, guaranteed payment of partners, but also outside of that, some of the non-reoccurring either incomes or losses, depreciation, depletion. Why do we add that back? Similar to what we said before. And of course, mortgage notes payable in less than a year. What does that mean? That was something that was problematic for the client we discussed. How do we kind of get around that? We'll kind of go through that as well. And our 1120S. 1120S is, S Corp, similar to a 1065, but a little bit different. Same thing. What are we taking out? What are we adding back from an income perspective? So this is the Fannie Mae form. This is pretty much typically what lenders follow. So let's just cross-reference this form. Let's start with a Schedule C. All right, so we're going to go over a Schedule C now, which is the first of 3 specific modes of self-employed income. Typically for conventional or FHA loans. Now, Schedule C is super popular for a sole proprietor or an LLC, not yet taxed as an S Corp potentially. So let's go over it together. So as you can see on our handy-dandy Fannie Mae worksheet, number 31 is going to be your profit. So again, if we're going to kind of look at this and mark it up with your boy's favorite color, blue, so all your revenue for the business is typically going to be found right here. So, it could be $100,000. Handwriting's not my specialty, folks. But with that said, we're looking at over here, right? We're looking at your net profit. That's where we start. So down here is going to be the net profit. So say, for instance, it only is $50,000. Oh. So that $50,000, this is what we're going to start with. Now, there are some things in here that are expenses, some things you can add back to this $50,000 number, as we see over here, some things not. So if we think of expenses, now in the case of, for instance, the barber shop, so you see right here, depreciation. Now, say some of the equipment is valuable and IRS has a whole code about depreciation. So say, $20,000 of it was expense as a depreciation write-off. Say from there, deductible meals was another $10,000 in expenses, right? So you're missing another $20,000 or so in expenses. Say Within here, repairs and maintenance, say another 10,000. So now up to 40, so we're missing another 10,000. Let's say insurance. You know, those that get their head shaved, they may bleed a lot, right? So you always be careful about insurance. So that's the 50,000 here, 20, 30, 40, 50. From that 100, there you go, the net profit was 50. Now, if we look at the worksheet, that 50,000, was there anything here that was non-reoccurring, meaning an expense that's not consistent? Now, it's very difficult, but sometimes if you can show a repair, that 10,000, if it's a one-time occurrence, and you can show what it costs dollar for dollar, maybe even get a CPA letter, you might be able to add that back to the 50. It's a little bit more difficult. But that's what a non-reoccurring item is, which is over here. You know, the non-reoccurring is just something that doesn't occur over and over. So if it's a one-time expense, you can't really hit them from an income net profit perspective. It's not consistent. You know, from their depreciation, we went over that. So right over here, that 20,000 in depreciation, it's a paper loss. It's not actual loss. It's equipment that loses value. It's an IRS tax code thing, but we can add that back. So if we're thinking about it based on this form, right, you had 50,000 as the net profit. We have nothing that's, say that $10,000, say we can show that it was non-reoccurring. So you're gonna add back 10,000 per this form, depreciation 20, now you're gonna add another 20,000, and then what else we got here? Travel and meals, entertainment. So IRS tax code, you can only write off a certain portion. So if there is something here under deductible travel and meal expense, you gotta subtract it. Oh my God, again? That really stinks. So over here you have 60, you have 80,000, right? If you add everything back together, which is higher than the 50, but you gotta subtract 10,000 again. This is just what it is. So now you're up to 70,000 again. Then from there you have business use of home. There is none. Amortization, casualty loss. Not really sure there's much passing away at barbershops. So that brings you to 70. So this goes to show you it's real simple to ascertain income off of your Schedule C. You know, a lot of people right here, this could be more zeros, right? It could go like this and have another 3. What's another 3 zeros between friends? It's $100 million in revenue. It doesn't matter. What matters is you start with this net profit number. But of course, obviously in this case, there'd be a lot more in expenses. Of course, from here, there are certain things you can add back to this bottom line number, specifically depreciation and depletion. There might be a chance, a one-time non-recurring expense like a repair you could add back. But of course, a lot of businesses, solopreneurs, entrepreneurs, there's a lot of like business development. And it gets a little gray. Was it really for the business? Or are you bringing your girlfriend or your wife or your best friend to a Jet game? You know, you never know. Could be for business. But of course, following the IRS tax code, you got to make sure that you're on the up and up. So you actually have to double down on whatever you put there. So some people may have 40,000, 50,000 deductible meals, entertainment, $4,000 a month. It's doable if you bring people out consistently. Just be careful because that gets taken out of your net profit again at the end. So as you can see, it's easy to figure out, but this is just a Schedule C. You know, there's some more sections, of course, in the back. You know, there could be itemized expenses here that aren't listed on that page. You know, it could be like marketing, right? Maybe like biz dev, business development. That's what we call it. You know, what else could it be? Something like maybe some kind of lead cost if you're going to break it down. And that's over here. This kind of gets aggregated together and it goes on. Where does it go? You know, in a section over here, right? 27A. So that would go right here. That's not a section that can be added back, guys. So all it does on page 2, you know, sometimes you have a business, you have a car you use for business. You know, sometimes you can add back in miles, believe it or not. That's a thing. It's not on this form, this Fannie Mae form, but it is actually a thing. It gets even more kind of depending on the lender you work with. But just rule of thumb, if you're really bored one day, you can Google Fannie Mae cash flow analysis form. It shows you exactly if you're a Schedule C business owner, if you look at this form from your accountant, whether it's going to be, you know, some of the information goes here like your EIN and various things. This won't show how long this business is open. That's typically going to be from your CPA letter. But you know, based on how long it's open, you know how many years of these you need. Maybe it's 1, most likely it's 2 if you're doing FHA or VA. But this form will show you exactly how you figure out income with all this information together. Now that's all good, right? But what if you're not Schedule C? What if you're now going to be our next example, which is the K1 and the 1120S from an S Corp. We're going to end with the 1065. So if we kind of scroll here, if you have an S Corp, right? So it's just, another way that your business is taxed. So the first thing we're going to check out is the K1. So your K1, as you can tell, so the K1 is basically like if you think of a W-2 or like a 1099, it's from the business, your net profit, which we'll go over. It's just the owner or owners, this is their amount that they made. So of course that goes right here. Say your K1 here is 50,000. We'll pull this over to the 1120S. Now over here, it's going to go your name and all the good stuff right here. It's going to, say good old Andrew Russell, my address, 123 Handsome Way. Don't judge. All right, so my kids are definitely going to laugh at that one, I'll tell you that. So what type of, percent do you own of the company? 100%. That's something that I own, obviously, there. And then there's some other stuff within here that might be part of the IRS side. But from a K1 perspective, as you see, right over here, the income's 50 grand, so we're starting good. And then real estate, sometimes a business or corporation owns real estate. Obviously, like in the case of, for instance, me and mortgage, that wouldn't be the case. So 50K is the income. Now, that's it, right? Just go off that. Nothing else? No, of course not. That's barely the appetizer when it comes to 1120S income from S Corp income. So this is the big form, guys. So as you can see here, for the 1120S, there's a lot more stuff that we go off. Now, of course, you saw the 50,000. So 50,000 is going to be right here. Because if the business owner is 100% owner, this is the net profit, goes on the K1, cool. But this form in and of itself has a lot more information, so let's kind of go over it. Now, if you file these, you probably know a little bit about them. I'm sure your accountant's gone over with you, but your EIN will go here. Basically, your business is social. This is huge. When was it incorporated? When did that business on paper, not necessarily when you open. So if you're a barbershop, as an example that we used, say they had to find a space and then they had to renovate it, right? They had to get water and electricity and heat and all the good stuff. You don't want to get your head shaved in the freezing cold without heat. That's all cool, and the build-out's great. It doesn't mean that that's when the actual corp on paper with the IRS was open. So that's the date here. Call that, 1/1/XYZ. It's a big thing for us to go off of because when was it open? Was it over 2 years? Was it over 5 years? It opens up a lot of questions. Here's the name and where the business is incorporated, the address. So first and foremost, you're going to see up here, right, the gross receipts or sales. Right here is the revenue. So a lot of business owners make the mistake of thinking, this is what I made. My revenue was $1 million. Unfortunately, look, how the heck did it get down to 50,000? That means there was $950,000 in write-offs. That's crazy. But this is something that's very typical. I've seen businesses with more zeros write it down to $50,000 to $100,000. So how would that be? So as you go through it here, cost of goods sold, for instance, if you get a product, so you get all this revenue, but some of the goods you had a cost, that goes here as an expense. And then that kind of comes down here for the total income before your future expenses. But from there, this is a huge section for expenses, which is comp of officers. Say, for instance, the owner got a W-2. The W-2 would go right here. Say they gave them stuff, $60,000. So now you're up to $890s left in expenses, right? Then the rest you got repairs and maintenance, bad debt, rent, tax insurance, interest, depreciation. Remember that, guys? Depreciation, depletion, advertising, all that. So say, for instance, you have a $250,000 depreciation, meaning you have a business, there's a lot of equipment, it could be trucking, cars, equipment, maybe at a space, you had very expensive stuff. So depreciation is an IRS, it's part of IRS tax code, but there's a way to write off your asset value of whatever it is, losing value over time. Say that's $250, from there now we're down to what, $640? Right, so we still have a lot more expenses to write off. Now, other deductions, attached statement, we'll go over that in a little bit. That's a big part of it. There's plenty of stuff that gets written off. So advertising, maybe $20,000 a month this firm does in advertising. It's another $240. So now you're down to $400. In a $1 million business, there's a lot of expenses, believe it or not. So outside of that, maybe rent, maybe your space is 10 grand a month. That's another $120,000 in expenses. So now you're down to what? 280-ish. And then from there, so this other deduction section, right? It says attached statement. As we go through this, before we go over how we calculate it, you kind of look more towards the back. Now, we've seen on the back of these, there's a statement. And it says, statement 1. And it shows all the other expenses, maybe like we said before in the other example. Marketing. Definitely not quitting my day job with this handwriting, guys. Leads. Expense XYZ, maybe legal. Meals and entertainment. All this stuff goes in the back, and there's all numbers, right? So with that said, right now we're missing, to make this clean, what was it, another 280 expenses. So the 280 goes back here. So, you have XYZ, ABC, and this is like another 280. So this statement has the remainder of the expenses. That pulls over to the front. So if we put it all together, you have 180, you have 240, right? So this brought it down to 890. The 250 brought it down to 640. The 240 brought it down to 400. The 120 to 280. So there you go. So all the math is mathing, even though this is a manual one, which is still fun. Put 280 over here. And that's how it gets written down to 50,000. So let's go through this together a little bit based on the form on how we actually calculate this income, because it gets a little bit confusing, but we're going to make it simple. So first thing is the K1, right? 50,000, nice and clean. We'll put that up here. So this person in $1 million business is starting with 50,000. Of course, there's 60,000. Now we're just doing a 1-year average, guys. We would do the same thing for the year before, 2023. We would check to see, is the income from a trend perspective, is it the same? It's going up, it's going down. It's going down, bad things happen in the self-employed mortgage world, so it's food for thought. If the income goes down year over year over 20%, that's when it gets a little bit spicy. So again, here we're starting, is if you look right over here, we're starting with 50,000. There was no real estate. That's the non-reoccurring income or loss. Now the depreciation, we can add that back. That's a lot. So in the case of the lenders not really dissecting the tax returns and adding it back, so this brings it to 300 right out of the gate. Then from there, we got amortization, casualty loss, some of the stuff we didn't have, depreciation, depletion we had. But there's 2 things we have to look for. One, because it's removed again, just like it was in a Schedule C. It's going in the back. So remember, we put here meals and entertainment. So say this number is 20,000, guys. Say of the 280 here, 20,000 of that 280 was meals and entertainment. Unfortunately, we actually have to go back. Even though we added that 250 in depreciation, which is awesome, we have to remove 20 again. So it's almost like you hit them twice for it. And there's all sorts of reasons why. So that brings it now down to 280 for the year. And then from there, the big thing with the client that we spoke about before is the mortgage notes payable in less than a year. So there's a section on the balance sheet that shows right here, mortgage notes bonds payable in a year or more, mortgage notes bond payable in less than a year. So this is the beginning, the end of the year. So right here, in this magical row, if there's a number, say 200,000, say this business had a $200,000 mortgage note bond payable in less than a year. That, my friends, would be very bad. It would be very bad because you would have to take that 280 and remove 200 from it, right? That's what it says to do over here. It says subtract that amount. But as we said, there are many lenders that are okay with a CPA letter saying, look, although over here, you see there's a $200,000 mortgage note bond payable in less than a year, this rolls over year over year, and it's been consistently doing that. And if you get that letter from your CPA or your accountant, we can actually pretend like we don't see that. So as you can see, there's a lot that goes into these tax returns. Just make sure, guys, again, description, click the link in the description, a cheat sheet for self-employed clients for income. I think I'm doing a great job slowing this down, but still it gets a little bit confusing, a little bit spicy. But with that said, this showed you an S-Corp's income, how you figure out, right? You have the all-in revenue, you have W-2, which say the owner's getting, the K-1, you can add back depreciation, you gotta subtract meals and entertainment again, because the IRS only lets you write off 50% of that typically, so that's why you have to add it again. It's assuming you actually had more of it, so that brings in a 280, and then some of these items, like for instance, this has killed mortgage application transactions with other people without them knowing in less than a year. Say that $200,000, which I showed you guys, say the accountant is not willing to write that, say it's not true, and it is due in less than a year, and they thought they made this 280 adding back depreciation. If you remove 200, qualifying yourself off 280 for the year or 80,000 is a huge difference. So again, this is all public information. Just make sure you review this, guys, and make sure, again, you download that cheat sheet. It just makes it a lot cleaner, but nonetheless, this is all public, and it's pretty easy to determine and figure out once you start doing it a little bit more. Now, the last one, save the best for last. The last one, of course, is going to be, here's your K1 again, guys, but also a 1065, a partnership. So let's go over what that is and the difference. All right, so as you can see here, same thing. Here's a K1, name, I'm Andrew Russell, 100% owner. Say over here you got 50 grand, same thing. So you have 50,000 here, but of course over here there's some guaranteed payments over here. So there's a section on, we won't do it in ours, but the section where, say they got a $20,000 as a guaranteed payment, you'd add that together and use both those for income off of the K1. Also, if the partnership owns any type of residential real estate or any commercial real estate, there's some rental income stuff that goes into it. So it shows you on a 1065 on the K1 what you can use and then what you can use. So that's the K1. But the meat and potatoes, of course, it lives on the 1065. What the heck is a 1065? Schedule C, Schedule E, Schedule A, B, C, D, 1120S. It sounds like I'm calling a football cadence, right? Hike. But no, a 1065 is for partnership income. Again, just to go over, here's the name of the partnership, the address it's registered, the EIN, which is like the social of the business. And then again, remember the date the business started. So it's not when you started actually opening and getting money. It's when the actual corporation opened from an IRS perspective. That goes here. So this is the typical front line of the partnership. You know, from there, again, it's the same thing. So as you see over here, there's the revenue, which goes up here. You know, we don't have to go over all the math again, but say it's $1 million. They're going to look over here to the business income, right? So that's what they're going to show this corporation of what was left over after all the expenses. You know, you have your salaries here. So say some of the owners or partners in the corporation got a W-2 or a salary to go there. Guaranteed payments go here. Maybe they pulled a 1099 or some cash from the business. Repairs and maintenance, bad debts, rent, all this stuff, depreciation again, remember? Depletion, all that stuff. So from an expense perspective, it's the same exact thing. It's going to be, you take your incomes, so something that is non-recurring, so say you had like a bad debt, I've seen added back, or say something happened from a legal perspective, at a one-time fee, that is something, if it's an expense, you can add it back, guys. Again, it's difficult. A lot of this relies on your CPA writing letters and giving a clear explanation. It's not that hard, but there are some CPAs not willing to put themselves on the line with some of these letters. So it's just food for thought. Always adding back depreciation or depletion. It's just more so a paper loss, not something specific. Amortization, casualty loss, if that does exist, you can always add that back because it's a one-time occurrence. And same with what we saw before. This will have, dun dun dun, your balance sheet again. Mortgage, note, bond, payable in less than a year. Would you even know to look here if you're the layperson? Of course not. But I'm showing you, this is exactly the row in the section that you have to look, because if you have something there, you are supposed to remove that from your net profit, which could completely take away the opportunity of qualifying, which again, with a CPA letter, you know, we talked about having that not affect you guys, but that's something here. It's something every mortgage guy has made the mistake thinking they know self-employed guidelines, not looking for that, and then something happens. It's happened to all of us, guys. Not in a long time for me. I still had blonde hair back then, but even now, it's just food for thought. Always make sure you know that section exists. And of course, the non-deductible travel and meal entertainment section. So typically there'd be another form, right? Because look, over here, other deductions attached statement. Now there's always a statement that kind of corresponds with these on more itemized expenses, you know, maybe more so for marketing, leads, you know, anything of the sort, but it could be travel and entertainment expenses because it only lets you write off a certain portion, so you actually have to remove it again. So this form is a little similar, guys, to the 1120S, but as you can see, if you look at this, you're kind of like lost in the sauce. Maybe you'll just go off of that net number over here, maybe add your wages, not even realize depreciation. If your business runs year-over-year depreciation, you could add that back, which helps you in a mortgage qualify for more. Maybe you don't realize meals and entertainment, you have to remove it again. And of course, that mortgage no bond payable in less than a year, I've seen that as a, bites you right in the buns, which is not an enjoyable experience, especially if you're the mortgage professional trying to explain that to a client. A lot of this stuff is a little bit confusing, but again, guys, this Fannie Mae form does the best job, and the 1065 is very similar to the 1120S. All right, guys, so now that you know how the lenders calculate self-employed income, make sure you watch the next video, self-employed home buyers, the numbers that actually matter, where I'm gonna go over the actual numbers, the nitty gritty, what numbers are needed for credit scores, for the monthly income, for reserves. What the heck is a reserve? We're gonna go over that. Down payment, all the specific granular numbers of what it takes to qualify. Make sure you watch the next video, guys. It's gonna be awesome.